I'm Darius McDermott from FundCalibre, and this is the Investing on the Go podcast. I'm delighted to be joined by both Carl Stick and Alan Dobby, co-managers of the Rathbone Income Fund, to do a budget reaction special. Gentlemen, good morning, and thank you for coming and talk to us.
Morning, Darius. Great to be here.
Good morning, Darius.
So let's just dive straight in. What's your sort of immediate reaction to the budget? Anything that sort of stands out that you liked or that worried you, from whichever perspective, whether it's fiscal or just UK PLC?
I guess there's quite a bit in there. I mean, I think our first reaction when the headlines dropped on last Wednesday was one of relief. We've had weeks, months of speculation and warning and kite flying about how bad things were going to be. The market consensus was that there was a 20 to 30 billion pound fiscal hole that was going to have to be filled here. So when we saw that headline come out, albeit a little earlier than we expected, that the Chancellor actually had 22 billion pounds of headroom after our budget measures, there was definitely a sense of relief within our team and within markets. We felt that was a big enough number to keep the bond market happy. And that's what we saw play out in markets. We saw stocks and bonds both rallying a bit in the immediate hours after the budget. So, I mean, obviously, the Chancellor had a few different objectives in terms of keeping her backbenchers on side, keeping the electorate on side. But, when it comes to the markets, in terms of reassuring the markets, I think it was a relative success. Obviously, in the days since the budget, we've now learned that maybe the Chancellor didn't have as big a fiscal hole to try and escape from as many of us believed. It wasn't such a big Houdini act that she was carrying out. She had 4 billion of headroom, according to the OBR, before she went on air on November the 4th to warn us that, or to kind of secretly warn us that perhaps income tax rates may have to rise. So I think, given what we've learned since, it's quite a tricky one for markets to digest. Positively, we can think, well, the UK's fiscal position was much stronger than any of us realised. We weren't in that fiscal doom loop that many people were worried about. Less charitably, we could say, well, maybe if we had a clearer position, a clearer view of the true fiscal position, then maybe we could have avoided a few weeks and months of economic pain, the paralysis in the housing market, businesses putting off investment decisions, M&A decisions getting delayed. We own Big Yellow in our fund. Blackstone are potentially interested in bidding for that company, and they specifically cited we need to wait and see what the budget comes up with before we make a decision. So, all that uncertainty was delaying decision making. So, positives and negatives, I think we could take from the budget.
Yeah, I think we do have a degree of frustration around this as well. We were hoping this was going to be a sort of cathartic, ripping the plaster off moment. But the whole saga of the budget, from the 4th of November through to this week, it's just dragged on, and it's just frustrating because actually, the UK economy, although it's not strong, it's not disastrous either. And I think the government had an opportunity to satisfy a lot of questions, and it was just a bit amateur, which was just annoying and frustrating. But actually, the outcome's not too bad for us.
Well, I know we're not here to listen to my opinion, but I'm going to offer it anyway. It's the second budget where an unnecessary, uncertain cloud was painted. And it's the second budget of sort of death by 1,000 cuts of what they might or might not do. And then the final delivery, as you say, may have been not as bad as predicted. Yeah. Do you think, again, whether it's from a fiscal point of view or when you're talking to companies, that it looks a little bit like a spend now, tax later budget? Do you think that has any impact on companies or the economy?
So much of what we do, we try to look at businesses over the longer term, and we know really well that once this all sort of washes through, give it a couple of weeks, we'd have forgotten about this. So it is going to have an impact, and we are very aware there are timing issues here. especially with regard to the fact that some of the tax rises are going to sort of come in sort of towards the end of the government, actually, which is intriguing in terms of timing. But that's their choice. I think we certainly think about how this impacts the landscape for our investors, and I'm not sure how much it does. I mean, I think the biggest issue we're facing is this argument around how good a place is the UK in which to do business, and how good a market is the UK in terms of stock market in which to invest. And, this, we've seen a flow of money leaving the UK, investing elsewhere over many, many years. And there's nothing in this budget that's going to sort of change people's mind if they've made that decision. The irony is we've also latterly seen a lot of money from overseas coming into the UK market as a matter of diversification. So I'm not sure that the budget actually changes that. I think if you're an overseas investor and you're looking for value, the UK market continues to look very attractive. I don't think the budget changes that. And from an equity point of view, valuation, I think there's an irony that it's a relatively low beta market. It's viewed as a safe port in the storm. And I think, again, I don't think the budget necessarily changes that. It may make people question that a little bit, but I don't think it changes that. We've got global companies. It's a good source of income. I think despite the noise, I think the reaction of the bond markets and the calmness around the budget, exhibited by bond markets, I think that actually it still supports our market and it still supports the valuation argument as well. So I think, a lot of noise. And yes, I take your comments with regard to timing, but I think we sooner or later we forget about this and then we move on, and how much has really changed.
Yeah. So I wonder if UK equities are still really good value, and I'm sure you'll have an opinion on that. And you talked about some overseas money coming back into the market. I'm sure part of that is because obviously the very strong performance of particularly UK large cap equities, and also sort of dividend, slightly either value or deep value oriented strategies. Have they had their run? Have people missed out? Or are we still cheap, especially, I'm guessing, relative to anything that looks US?
Yeah, well, as UK managers, it's lovely to be asked that question. To be in the circumstance where the FTSE All Share has had such a good run. It's up over 20% this year. But as you alluded to, the valuation still remains very attractive. It trades on under 13 times forward earnings. That compares to about 23 times for the S&P 500. Even if you adjust for the different sector mix between the two markets, still the UK still looks very cheap. As we have been constantly reminded over recent years, that valuation is only one part of the story. We need to look at other things as well. And I think something that is sometimes a bit overlooked is the diversification benefit that the UK market can offer. Because of its high weightings in sectors like consumer staples and healthcare, it has this very defensive, value-oriented tilt, which makes it a pretty useful hedge against the more growthy US market or the more cyclical European market. We've seen the benefits of this play out just over recent years. If you think back to 2022, when we had this, the start of this inflationary period, interest rates starting to rise, we had every asset class, every geography was getting hit by this. I seem to remember, actually, I think the NASDAQ was down about 25% sterling terms that year. But against that backdrop, the UK managed to eke out a very, very small positive return. Again, this year, we had the tariff tantrum earlier in the spring. The UK held up relatively well, not because we were getting a kind of more favourable treatment from Donald Trump, but because the UK is one of the lowest beta developed markets. When investors are worried about global downturn, the UK tends to provide relative stability. And I think, just comments on overseas markets, Carl alluded to earlier as well. I think the timing of the budget was unfortunate because we were starting to get overseas investors coming back into the UK earlier this year. I think they were put off a bit over the summer. We are hopeful that, we can point out the pluses and minuses from the budget, but hopefully it should prove to be the clearing event, we thought. Because there are still great attractions to the market. It is still a very international market. 75% of revenues coming from overseas. So it's a great way for international investors to access global growth in a relatively cheap way. And even the domestic part of the market, we think FTSE 250 is pretty attractive at the moment. Yes, there's challenges in the economy, but mid caps are trading at discount to large caps. That's a relatively rare occurrence. We think parts of the budget were pretty disinflationary, so there shouldn't be anything to stop the Bank of England keep cutting from here. So that could be a powerful tailwind for that part of the market as well.
So let's dig a little deeper, because we sort of touched the bigger picture stuff. Whereabouts in the UK market are you still finding opportunities as we sit here post-budget?
Back in 2021, we only had 13% of our fund, 13% of our fund invested in the FTSE 250. Today, it's almost a quarter. We've been adding to that recently. We've got a big watch list of mid-cap stocks. As I said, they should benefit if inflation and interest rates keep trending lower. I would highlight there, we're not macro investors. We're very much stock pickers, but we do think it's important to be aware of the economic backdrop. We do always want to be trying to invest with the wind at our back rather than kind of into headwinds. From a sector point of view, if we think about which areas should gain the most from falling inflation and bond yields, two real groups that we're interested in here. First, the direct beneficiaries of lower interest rates, house builders, retailers, etc. And the other ones are the bond proxies, those stocks that everybody is very keen on in the previous decade. The kind of lower for longer decade, long duration stocks, steady cash flows stretching out as far as the eye can see, kind of utilities, REITs, those kind of areas. So those are the two groups, the direct beneficiaries, the indirect beneficiaries, the bond proxies. On the direct beneficiaries, house builders, obviously the housing market's been in hibernation for months. It's been held back by high mortgage rates, not helped by the fears we were mentioning earlier on, all the uncertainty over the summer. Would stamp duty change, council tax change, the mansion tax, etc. So decisions were being put off. Now that we have more clarity on the tax side, and we believe that mortgage rates will keep coming down, we would hope to see demand recover. It would have been nice to see something in the budget to help stimulate demand. Some kind of rebranded version of Help to Buy would have been great. I don't think there were huge expectations of that, but we think that would have been helpful, because actually we're reasonably positive in some of the supply side measures that the government's put in place in terms of the planning and infrastructure bill, more planning officers, these kind of things. There's a lot of work still to do, and I'm not suggesting we're going to get to the 1.5 million new homes this Parliament that the government has been talking about, but we can certainly improve on the very low levels of house building that we're doing at the moment. And
I think despite the very strong UK market, I think people just forget about how strong the UK market has been. As a market, it's still relatively cheap, and the gyrations that have actually afforded us opportunities of more high growth, high quality businesses that have actually been derated. So I think the one which we've actually added to quite significantly over the last month is the media business RELX, where we've seen this is a darling of the market. I mean, a lot of, it was one we've owned for some time, but we did actually take profits a little while back based upon valuation. We still argue, the biggest determinant of the future returns you're going to get are the price you pay for a stock. So if something's expensive, you should be taking profit. Over the summer, the shares have derated because people have been questioning quite correctly, as we have, the impact of artificial intelligence on their model. But we think the shares have come back so far now that risk is being priced in. So we've been able to quite significantly add to that position. So it's not just buying defensive stocks, and it's not just buying UK domestic stocks that look cheap. It's also buying high quality global growth businesses that have been caught up in some of the volatility at prices that we think are very attractive versus the long-term history. So there are lots of shots we can play. And that's despite the movement in the market. There's a lot of opportunities in lots of different areas. So, of course, we are not unbiased observers here, Darius. We are excited about our market, and we should be.
Maybe just a little bit on the mid-cap part of the market. So I think reasonably well understood, large cap, mostly overseas, often mature businesses, good dividends with some dividend growth. And more recently, and I use recently, share buybacks. What's the dividend, I would say culture, maybe is a bit highbrow in the mid-caps, and are mid-cap companies as keen to buy their shares back as maybe some of the largers are? And you can speak generically. It doesn't have to be on a stock basis.
I suppose it is actually more on a stock-by-stock basis. There are some mid-cap companies we speak to who are all over the kind of buyback trade. And actually, even within the large caps, it's quite different. There's some large cap companies that we speak to who, I can think of one in particular, who talks about the buyback as something they do to mop up any excess free cash flow that they have. Whereas I can think of a mid-cap company who do a very detailed calculation about the returns that they can get on every bit of capital allocation, whether it's reinvesting back into their own business, doing M&A, paying down debt, acquiring a competitor, or buying their own shares. They'll actually say, there's one, I won't name the company, but they said, we think we can get a theoretical return on buying back our own shares of 20%. So that is the kind of internal hurdle rate that divisional managers have to go to the CFO and say, well, this new project expanding into a new geography, a new product line, if it doesn't return more than 20%, then the CFO will say, I can get a very low risk buying back my own stock. So it is very stock specific. One question we quite often get actually about buybacks is, well, you're income managers, surely when companies decide to buy back stock rather than paying dividends, then you're going to be against that. But actually, if you look over the medium term, if you're buying back stock, if you're reducing your share count, then dividend per share should go up.
Yeah.
So it's actually, and we're very interested in dividend growth. As you know, we've got a great track record of dividend growth in our fund. So that's something we're interested in. It's dividend per share, not kind of absolute dividends in pounds and pence.
And I think, just on your point, there are a couple of points I want to make. It's funny, we talk about mid caps, mid 250, but I think we know jolly well that within the UK market, the top 16 businesses are the ones that are really powered ahead. So you could look at the UK market and almost like say mid caps are everything below the top 16. I don't know, we divide them, it's arbitrary. If you're looking at a business like a Legal and General, it's 13 billion. That's a tiny US business. These businesses are small versus over the Atlantic. So that's the first point. I think the second point, and which we've always stood by, is that when we look at any business, it doesn't matter what market cap, what industry it's in, we look at the cash profits that they generate. And, how they pay back the taxman, how they pay back the people from whom they borrowed, how they invest in the business for maintenance, how they invest for growth. And at the end of that, you've got cash, and then they make a decision. Do they pay it back to us as in dividends? Do they buy back shares, based upon the principles that Alan's just explained? Or do they keep it within the business? That basic analysis of a business is what we do. It doesn't matter what market cap. It could be 100 million. It could be 100 billion. The third thing, which again, we haven't thought of that much in the last week, but I think is going to be relevant, is obviously the changes in the budget around income on dividends, or tax on dividends, beg your pardon. Whether or not that changes company behaviour. Because obviously we're looking at it in terms of allocation of capital, but if companies are thinking about shareholder returns, does it actually sort of, they think we're going to get, our shareholders are going to get less bang for their buck if we pay back dividends. Does it change behaviour on the margin around share repurchases? I don't know the answer to that, but it's definitely something which we're going to think about.
Yeah, I'm sure that's one maybe for the year ahead, and how companies actually do actually react to those changes. So one to look out for. Maybe just a bit more basic. One of the tax treatments, apart from the dividends, which we touched on, was sort of salary sacrifice. Is that something you hear of a lot in companies? Is that something which is really sort of quite a common incentive or way of not paying national insurance on pension contributions or whatever it might be. Is it a major thing, or is this just another headline? And then with that being reduced, does that make ISAs more popular potentially?
But I think certainly, obviously, the incentive to actually keep your investments within a tax wrapper and a tax efficient wrapper is even more relevant now. So certainly in terms of the ISA allocation to equities, the changes there, and obviously we would argue for the compounding benefits of income funds within an ISA. Again, of course, we're going to do that. And I think we have, we've long advocated the important role that income funds can have to pension provision. It's not the solution, but it should be part of a solution. And as I said, look, we try and invest in businesses that are best able to grow their distribution. So not just pay out a dividend, but through their own organic growth or acquisitive growth and capital allocation to actually generate that earnings growth that comes through to dividend growth. So with that combination of income and capital growth is going to be relevant to any sort of planning around pension and so on and so forth. So I said I don't want to get into the minutiae of that planning out argument because it's definitely not our area. But I think our argument around the flexibility of income funds when it comes to pension planning still certainly stands.
So I'll ask one last question, and I'm going to ask it in a leading way. And given that my audience are UK equity investors, so people are looking at their portfolio. So when I started in this industry a couple of 3 decades ago, the vast majority of UK investors held UK assets first. They were incentivized from tax, your overseas allowance, and the UK was a very, very good place to invest in the noughties and actually outperformed the US. Then post-GFC, we've seen this massive rise of tech and US equities. Should UK investors revisit the UK? Should they be thinking, not necessarily even of selling US to buy UK, but allocating to the UK going forward in a bit more of a portfolio rebalance, I suppose, given the things we've talked about, diversification and valuation as well?
Yes.
Yes, I mean I love a simple answer to a leading question.
No, but I think that's obviously it's not up to us to give investment advice. But I think you're right. There's been this multi-year, multi-decade shift, and we know the reasons why. I think most of the people who listen to this podcast, they've got UK assets, UK liabilities. A lot of them, so much of the sort of negative vibe has actually come out of the UK. We've talked ourselves into a very negative position. I don't think anybody should be making a knee-jerk reaction to the budget. I don't think, as I say, that it's going to necessarily change people's negative view with regard to the UK market. But as I said, the UK market has been a great place in which to invest over the last 5 years. It's almost like it's the story that's not been talked about. It's been astonishing, the UK performance. This year, we're up 20% investing in this market that nobody wants to touch. Look at the press at the moment. Again, this is press, this is noise, this isn't fact, but there's definitely greater jitters around valuations within the US. Think about their political environment, think about their tech environment. There's a lot going on in the world, and yet we seem to afford valuations to US businesses that are stratospheric compared to ours. They are different businesses. They are world transforming businesses, but that you can create bubbles. Now, I'm not here to say there is a bubble in the US market. I'm biased, but I do think from a diversification point of view, UK investors with UK assets, UK liabilities, they should be thinking about the risk that's appropriate in their portfolios. And if you think about it in those terms, there is an argument, unbiased as we are as UK managers, there is an argument to be thinking about, actually, is it appropriate to be reallocating some of those funds to the UK? Now, it doesn't take much, because the amount of money that's shifted across, you've only got to have a little bit of money coming back into the UK, and suddenly the UK's outperformance of the last 3 years will continue into next year. because it won't take much money to start coming back when you aggregate that with the overseas money that is seeing the opportunity within the UK.
Alan, any last thoughts from yourself?
Just as Carl was talking there, I mean, I was encouraged. Just a story in the FT a couple of days ago about domestic pension funds allocating more ex-US, so into the UK and other markets. That's the bit that's been missing. We actually, it was slightly ironic that we had international buyers coming back earlier this year to the UK market while domestic investors were still selling. So if we can get both of those things, it'd be nice to have both of those things going in the right direction at the same time. So, I mean, I think there's definitely reasons to be positive heading into the UK next year from a valuation perspective, a diversification perspective. We've got the budget out of the way, so we can kind of move forward with clarity, I think.
Alan, thank you very much. Carl, thank you very much. It's been a really interesting chat on the UK market post-budget. So thank you for taking the time to talk to us.
Thank you, Darius.
Thanks, Darius.
If you would like more information on the Rathbone Income Fund, please do visit FundCalibre.com. And if you've enjoyed this podcast or any of our other podcasts, please do like and subscribe to the Investing on the Go podcast.
Please remember, we've been discussing individual companies to bring investing to life for you. It's not a recommendation to buy or sell. The fund may or may not still hold these companies at the time of listening. Elite ratings are based on FundCalibre's research methodology and are the opinion of FundCalibre's research team only.